India's stock markets may soon be governed by an entirely new rulebook. On Thursday, Finance Minister Nirmala Sitharaman tabled the Securities Markets Code Bill 2025, a proposal that would overhaul decades-old laws and significantly reshape how India's capital markets are regulated. The government says this is about modernizing regulation. The opposition warns it could put too much power in one regulator's hands. So what exactly is changing and why does it matter? India's markets today look very different from when many of the current laws were written. Trading is digital, products are complex, retail participation has surged. But some of the laws governing these markets date back nearly 70 years. The government says that gap is now a regulatory risk. So what does the Securities Markets Code Bill actually do? Well, before we get into the entire story, let's take a quick break. The bill proposes to merge three key laws into one single code. The SEBI Act of 1992, the Securities Contracts Regulation Act of 1956, and the Depositories Act of 1996. So instead of multiple overlapping statutes, the idea is one unified framework for the entire securities markets. According to the government, the existing framework was written for a very different market, does not fully reflect digital trading and modern products, and often creates overlap between regulators and rules. The new code aims to simplify compliance, reduce duplication, and make regulation more predictable. And a major part of the bill focuses on SEBI itself. The code proposes changes to how SEBI functions. Board members will have to disclose conflicts of interest. Stakeholder consultation will be mandatory before framing regulations. Regulations will be periodically reviewed. SEBI will also be allowed to maintain a reserve fund and transfer surplus funds to the Consolidated Fund of India. The bill also enables regulatory sandboxes, allowing new financial products to be tested in a controlled environment. Enforcement is where some of the biggest changes come in. The code separates investigation from decision-making, introduces a single adjudication mechanism, sets timelines for enforcement actions. Importantly, minor procedural violations will no longer be criminal offences. They'll attract civil penalties linked to gains made or losses caused. Serious offences like fraud and market manipulation will still face strict action. So what does this mean for investors? The bill proposes an ombudsperson for faster complaint resolution, quicker grievance redressal, clearer enforcement and appeal processes. The government says this will strengthen investor protection while reducing fear of over-criminalization. But the bill has triggered political pushback. Opposition leaders, including the DMK's Arun Nehru and Congress's Manish Tiwari, they argue that merging laws and expanding SEBI's mandate concentrates excessive power in a single regulator. They say stronger checks and parliamentary oversight are needed. The government says those concerns will be examined by a standing committee. For now, the Securities Markets Code Bill heads for detailed scrutiny. If passed, it would mark one of the biggest rewrites of India's capital market laws in decades, with long-term implications for regulators, companies, and investors alike. That's it for this episode. For clear, no-frills explainers on policies that shape the economy, like, share, and subscribe to Business Standard.